Hello and welcome to Kitco Mining's Digging Deep with me, Paul Harris, here in person at the 2025 Mine to Money Conference in Miami, in Florida. Joining me is Nicole Adshead-Bell, Director at Cupel Advisory. Nicole, welcome back to Kitco.
Thank you very much for having me, and it's nice to be seeing you in Miami.
It is. It's lovely actually doing this in person, and so we can work on each other's cues and things of that nature. And we're going to have a fun time. Now, 2024 financial results, we're in the midst of that. The biggest companies reported: Agnico Eagle Mines, record margins; Kinross, their earnings have soared; and Newmont, they reported last night, very, very good positive numbers. Most of the companies have reported increases to their all-in sustaining costs. Gold prices are increasing more, so margins are increasing. The exception is Newmont. Their all-in sustaining costs actually came down 5% year on year. We seem to be getting into a much healthier position or space in the gold sector. Is this what it's going to take to reignite investor interest?
Absolutely. I think from the generalist perspective is when you start seeing true margin expansion. And I think we're in that environment where the gold price is moving more rapidly than the inflationary pressures. And so that's the tickling of interest, I think, that occurs, that starts to get, and that's the marginal investors that we need, because those that love it the most, we've been exposed for a long time through the ups and downs.
I suppose this is one of the things that arguably investors have been waiting for. Gold prices have been high and going higher for quite a long period of time. We haven't seen that trickling through into the results, and now it seems finally we are. A couple of standouts in terms of all-in sustaining cost margin. There's a number of companies that have more than $1,000 per ounce all-in sustaining cost margin. Lundin Gold and Dundee Precious Metals, where of course you're a director, they're sector leaders at more than $1,700 per ounce all-in sustaining cost margin. Those are some pretty eye-watering numbers.
Absolutely. Obviously, it's nice to be on the board of a company that's generating material free cash, and a shout out to Ron Hochstein. He's done an absolutely superb job of advancing an asset in a difficult jurisdiction and generating unbelievable free cash flows. And so it's nice to see him seeing the recognition of that being reflected in the share price as well.
And he's a former Kitco Mining CEO of the Year award winner.
Sorry, I interrupted you, but a very well-deserving one.
Okay, now, as I mentioned, Kitco reported last night, one of the figures that they included, their shareholder returns last year were $2.4 billion, roughly split between dividends and share buybacks. Overall, there's still more companies yet to report. The companies I track have returned last year more than $6 billion to shareholders, about 2/3 of that through dividends, about 1/3 through share buybacks. That's about approximately twice the amount returned in 2023. So again, it seems things are starting to move in the right direction. But question, should companies be more aggressive in their returns to shareholders?
I think when you start to see underlying commodity prices rise and you start to see margin expansion, investors become less concerned about balance sheet discipline and dividends and buybacks, and more focused on the growth equation. I think that's generally the pattern of behaviour. And so I think probably most boards and management teams are having that discussion at this point in time. Do we want to increase our dividends? Obviously, we've seen gold price run up very, very rapidly. Those companies that have controlled their costs well, you're seeing material margin expansion, a lot of cash building on the balance sheet. But I think what you'll start to see is a focus on growth, and that's going to be reflected in increased M&A.
Now, you're a director of one of the mid-tier producers, Dundee Precious Metals, as we mentioned. To what extent do you look at what other companies in the sector are doing? And I won't necessarily say benchmark against it, but to what extent does what other companies do impact your decision making? Where am I going with this? As I mentioned, Newmont returned $2.4 billion last year. That was $1 billion more than in 2023. So they're obviously trying to be more aggressive, pushing the envelope there. Will that force other companies in the sector to perhaps go the same way?
I think theoretically all companies are looking at all companies all the time. And so that you do definitely see themes of behaviour that sweeps through our sector. And whether it was all the Australian mid-tiers a number of years ago acquiring assets in North America, so in all companies in North America. So I absolutely think that the industry watches what other participants in the industry are doing.
Okay, now it's not all good news in the mining space in terms of the result and in terms of dividends. Major miner BHP slashed its interim dividend to an 8-year low of 50 US cents per share due to ongoing weakness in the iron ore market. I think perhaps people sometimes get caught up in the euphoria of one sector and expect dividends to be rising or returns to shareholders to be rising across the board. Obviously, that's not the case. What are you seeing in the copper space?
I am very biased about copper. I think what we're seeing in the copper space is, again, you're seeing M&A activity on the producer side. I do not think, and I am chairman of a copper developer, Hot Chili, you're definitely not seeing that love reflected down into the developer space. In fact, I think Canaccord just recently put out some numbers showing that the copper developers are trading at an average PNAV of 0.35. And that says that the market is saying, we're not giving you the inherent value that your asset base represents. And so, again, and you could argue I'm somewhat biased in this, is I think that M&A focus and that investor love, if you will, you'll start to see that trickle down in the developers on both the gold side of things and also the copper side of things. And that's what always happens as a cycle matures. And we're seeing a lot of M&A with producers in the gold space. We're seeing it the same with the producers in the copper space. And at some point in time, investors want to see growth, and the easiest way for a company to grow is not through exploration, it's through acquiring companies and or assets.
Now, I mentioned BHP for a reason, not just to talk about their dividend, but when they reported in their results presentation, they had a very interesting slide about copper and the capital intensity of their projects, their brownfield expansions, and what they see in the copper space as well. And one of the messages there was perhaps that for any developers is if your capital intensity is on the wrong side of their number, you're probably not going to get bought.
That too, but I also think that the leaders of our sector, the time to acquire as an investor, you want to be in the uncrowded trade. I don't think that's a word, but you don't want to be in the crowded trade because there's less potential for upside. And normally what you see is the time when the developers are unloved, that's actually when the larger companies should be buying them. They never do. They tend to come and make acquisitions as a cycle matures and after everybody is re-rated and trading at multiples of where they are today. I would say that you are not going to see any new material investment in new copper development until we see a much higher copper price. And I've been saying this for a couple of years. I've been wrong for the last couple of years, but I think that incentivization price, if you will, the price at which you'll start to see material deployment of capital, I think that's $6 to $8. I don't think it's happening at these prices. And so really what we need to see is a parabolic increase in the copper price before you start to see material development in the form of building new projects. And in the meantime, with the supply demand, this perfect storm that we're in, we're starting from 2020, 2025, you're seeing projections showing primary copper production starting to decline. And so I think the world has to start to take notice of it. And I think maybe the leading indicator of how concerned the experts in the sector are about primary copper supply, we are seeing record low treatment charges and refining charges. There is not enough copper concentrate to feed the smelters out there.
Now, the copper price has been relatively flat over the past couple of years, but earlier this year it really started going up again. Copper futures hitting sort of $4.80 per pound, pulled back to, let's say, $4.50 per pound. What has changed?
I think Trump has changed. And
Trump hasn't changed, he's just got back into office.
That's right. That has been the very, very material change. And I find it a little fascinating also because you have President Trump, he's also talking about resources in a very, very public way. I think the average person didn't until the last few weeks, for example, have any idea what rare earth minerals are, or lithium, or critical minerals, or copper. And so I think what you're seeing with this change in government, an acknowledgement that security of supply of key metals is crucial to your nation's longer term security. I think it's fascinating to watch our industry, which is unknown and unloved, is getting talked about in a very different way than what you've seen from previous administrations.
It does surprise me when I see a metals-related story, whether gold or copper, appear in a newspaper that I wouldn't expect to see.
Yeah, or on the BBC.
Yeah. Okay, you mentioned a little bit about M&A in the copper space. There's been some big deals touted, but not consummated. What is holding the big deals back?
What always holds big deals back is social issues. And so at the end of the day, when you have two companies get together, someone's going to lose their job. And so what happens, I worked as an investment banker for a number of years back in the mid-2000s, And there were so many deals that we were involved in that got to a very, very advanced point that would have made a lot of sense for both shareholders. But at the end of the day, someone doesn't want to give up their job. And so if you're a large investor or an institutional investor of a larger company, I think it behooves you, if you want to see consolidation, it behooves you to be expressing that strongly to management teams.
Okay, let's bring that sort of conversation into the gold space. Newmont successfully divested 6 mines. They were looking to raise $2 billion. They raised $4.3 billion. Some surprising values to the upside and to the downside there. But many people think that those divestments overhung M&A activity in the gold space. There were dozens of companies involved in those processes. Obviously, dozens of companies were unsuccessful. So presumably they're out there looking for assets. What do you think is going to happen in the M&A space in the gold sector this year?
I think it goes down the food chain. It has to. You can't underestimate FOMO driving behaviour. And again, as I mentioned at the start of this conversation, these themes of behaviour that you see, I think the stat was there's something like 13 single asset companies either with producing assets or with very advanced near-term development assets in the world. I haven't actually checked those numbers, but suffice to say it's not that many. And so you've got a smaller and smaller, and the single asset I suppose, group of companies that tend to be the class that the mid-tiers go after. And so I think you're going to continue to see M&A be a dominant theme. And once all those producers are gone, everybody has to start looking down the food chain. And so that, to me, again, I think the developer sector is pretty unloved based on relative valuations. They're trading at deep discounts to NAV, and that is where the value lies. And so I think at some point over the next year, we'll start seeing developers being acquired in a much more aggressive fashion.
I think there's about 15 or 16 gold producers in that $1 billion to $4 billion market cap range. So it does seem there needs to be some consolidation there to get the scale to break out and differentiate and get up to that big tier.
Yeah, I think you also in this kind of environment start to see like for like. But ironically, I think like for like or mergers tend to happen in a weaker commodity price environment, because when you have a commodity price running, it re-rates everybody's view of themselves and what they can do and what they can be. So ironically, there potentially is less. It makes a huge amount of sense. We want to attract investor attention. And when you're talking to the average generalist investor, for them, small cap is $1 billion. And so how do you get big enough and have the liquidity enough? Then when people go, I want to own gold, and there's a perfect size company that has got a sizable production base, strong balance sheet, if you want to talk the perfect company, and can demonstrate growth. They're the kind of companies I think that generalists will look to, but that requires size. Okay.
Another sort of news item that's sort of caught my interest recently, which may or may not be a news item, is there was a story out that Barrick Gold may look to re-domicile from Canada to the United States. Presumably that's because in the past it has co-invested with Chinese companies and may want to do so again as it continues to grow out its copper business theme. If Barrick does re-domicile, that would obviously further hollow out Canada's mining sector. It seems very short-sighted of Canada to penalise its resource sector for working with one of the leading sources of capital in the sector. What's going on?
Crazy. Honestly, it doesn't make any sense. And I think it's an incredible overreach of the government. And I'm a nationalised Canadian, so I can criticise Canada. There will be an election this year. And so that will be interesting to see what happens and to see if there's a change in tone and dynamic as a result of that election. But as you said, Chinese entities have been a material source of capital for our sector. And as a government to say to a company where your assets aren't in Canada, to say you are not allowed to have Canadian investment to allow you to advance that asset base. So if you have assets in Ecuador or Chile and the Canadian government is precluding the Chinese investment, I think it's terrible. And if I was a country where that asset isn't getting advanced because of a lack of development, I'd be having very serious conversations with the Canadian government. Fair enough when it's an asset within your interest, when your own country, because ultimately your resources are also the resources of that country. But I think there needs to be a change. I think it's rather shocking to say the least.
Okay, let's finish on some financing action. Digging Deep sponsor Revival Gold entered into a non-brokered strategic agreement with Dundee Resources for Dundee to purchase 10 million, to basically invest 3.2 million Canadian and take a 5% stake. I have to note that that's not gold producer Dundee Precious Metals, of whom you're a director. It's great for Revival, Nicole, to get an endorsement from another key sector investor. But what does it say, do you think, about investor interest in development stage juniors?
I think that Dundee, the team behind Dundee, they're very, very smart. They're very experienced about the resource sector. Jonathan Goodman has got probably unparalleled experience, has been involved in some very, very material successes. His CFO and EVP, Lila Murphy, again, she comes from the buy side, has lived through multiple cycles. So I think what this says is this is the smart money deploying capital. And I think it was a good deal for both companies. And again, Revival Gold has got some mining industry stalwarts behind it and led by Hugh Agro. And I think that this kind of transaction allows them to advance their business and allows Dundee to be exposed to material upside. Again, in this, what I think is it's very undervalued, the developer space. And this is long-term capital and smart capital. I think it's great.
Okay, another financing that was less well received is West Red Lake Gold. It announced a bought deal financing that was upsized to $23 million Canadian. Back in October last year, they raised $73 million. So I think it surprised a lot of people that they're having to come back to the market again. Consequently, the stock sold off 17% on the news. 2 weeks ago, I wrote for Mining Journal an article about the company and suggested that they may need to raise 10 to 15 million to have a cushion against the potential working capital pinch as the company brings its Madsen mine development in Ontario in Canada into production in coming months. They complained about this, but as time has shown, I was spot on there. Nicole, is the Madsen project, the Madsen mine, the mine that keeps on taking? Is it a money pit?
Look, I have sympathy. This is it's very, very difficult when you are a producing company or an advanced developer and you can't stop spending money. And to me, that's the situation they're in. They can't stop. And so it's a challenging asset. Obviously, the previous company owners that ceased to exist because of this asset. And I think what often happens in our sector is we're optimists, we have to be. To be in mining, you have to be a perpetual optimist. And so what happens is there's maybe an underappreciation of the time and the capital that it takes to get an asset to a point where you're no longer needing to access outside capital. And what we're seeing, to me, is this very, very classic example of it's a little bit death by a thousand cuts. Is you're raising enough to just keep going forward a little bit, and often what I think is maybe an approach that often isn't taken, but is an acceptance of the reality that to be very honest with yourselves, go how much do we actually need, and let's raise it all at once. And that unfortunately doesn't happen very often. And so I think we're seeing those classic examples of just pushing that working capital can down the road.
When West Red Lake took over the asset, I think they bought it for 5 or 6 million Canadian. They called it, the bargain of the century, which maybe it was. One of the things they've said and they've done over the past couple of years, they've spent sort of $100 to $200 million doing the work that Pure Gold didn't have the finance to do. And yet here we are, they still need more money.
That is the sign of a challenging asset at the end of the day.
Okay, as I mentioned, the stock fell 17% on the news, so maybe the company needs to consider changing its ticker symbol from WRLG to PADI. And I don't mean the dive company either, it's put another dollar in.
Oh, it's a challenging business. No, look, I feel for them, but these are very classic signs that we're seeing of an asset that's very difficult.
Okay, we've got BMO coming up just around the corner and then PDAC. What are you looking forward to at those events?
Not looking forward to the cold at the PDAC. The BMO conference, look, that's probably the best conference in the world. You would sell your grandmother to get into that conference. And so it's wonderfully done. It's a great it's a great survey of the industry as a whole, because it's gold, it's copper, it's diversified, it's the largest companies in our sector, and it's also some of the smaller companies. And so it's a great snapshot, I think, of what's going on in the industry, and you get to hear it from the corporates and you get to hear it from the investors. PDAC, obviously, it's a little bit different. Craziness of the PDAC, thousands of people circling around. I'm giving a couple of presentations, and so I suppose at the moment I'm focused on making sure I have those prepared.
I will be moderating a panel at PDAC as well. We will be there with Kitco Mining at both VMO, recording video interviews like this, and at PDAC. I look forward to seeing you there at both of them.
Absolutely. Thank you very much.
Well, Nicole Adshead-Bell, it's been a pleasure. Thank you very much for joining us again today.
Thank you very much for having me. It's always been a pleasure.
And if you like what you see, don't forget to hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.